The retail banking sector is over-levered. I don't think that 7% is actually a good number in terms of well-capitalized. I think that too many banks try to be too many things. Too many banks try to lend in 400 business sectors. The idea that they can afford to have underwriting capabilities in 400 sectors, even if they're as big as JP Morgan Chase, is silly. I think, too, that banks have come to believe in the too big to fail dictum. You look at banks like the Bank of America, where if you mark their portfolio to market in terms of their time spread, they're actually upside down. But the banks are allowed, the big banks are allowed to, from my point of view, perpetrate fraud. They're allowed to carry those loans on the books if they say the loan is held to maturity at the face value of the loan, rather than the net present value of that loan at today's interest rates. So banks are taking on time spread still, borrowing short and lending long. That's okay until it isn't.
Yeah.
If you're funding in the overnight market, and like 2008, the overnight market goes away, you're done. You're toast. I think that's a big problem.
In this insightful discussion, seasoned investor Rick Rule sheds light on the challenges plaguing the U.S. retail banking sector. Backed by compelling data, Rule argues that the sector's over-leverage and the pursuit of diverse lending across 400 business sectors raise concerns about its resilience. He criticizes the too-big-to-fail mindset and highlights the potential for fraud as banks carry loans at face value rather than considering their net present value. Rule advocates for a return to the fundamentals of banking, emphasizing the need for prudence and caution in risk-taking. Moreover, he shares his unique perspective on the industry, drawing from his experience in establishing successful internet-only banks. Stay tuned for more financial insights and don't forget to like, share, subscribe, and enable post notifications for the latest updates.
I believe that they're operating under a false set of assumptions. I believe that they're encouraged to operate under that false set of assumptions by our own government. But I believe, in addition to that, as we stated earlier in this discussion, the period 1982 to 2022 was the most benign economic period in human history.
Yes.
What the bankers have learned is that if you take risks, you get paid.
Right.
I don't think that's what a banker is supposed to do. I think a bank is like a self-administered bond portfolio. It's a wonderful place to be if you are good at blocking and tackling. Banking is a great, great, great business if you don't get anything wrong. But people have been encouraged to get things wrong. And that's really scares me. I mean, I knew some of the guys at Silicon Valley Bank.
Yeah.
They were really smart guys. They
Right.
were fantastic tech bankers.
For sure.
But they got themselves involved in a circumstance where their asset book had a long duration. I don't think it was the Federal Reserve's fault. It isn't. I mean, the loan book of Silicon Valley Bank was not the Federal Reserve's fault.
Sure.
It was Silicon Valley Bank's fault.
Sure.
I cut my teeth in business in the decade of the 70s, where a 1% rate increase, driven by the market, not by the Fed, was a weekly event.
Sure.
All these young guns, and perhaps they were too young, at Silicon Valley Bank needed to do was familiarize themselves with history, and they wouldn't have made those mistakes. They teach you in university about time spreads. Time spreads were responsible for the demise of the U.S. savings and loan industry.
Yes.
These guys either don't remember their second-year money and banking course. I can't explain that failure. I need to say that one of the things I did in retirement, which I don't recommend to anybody else who wants to be retired, is I'm starting a new bank. This bank is really a function of the fact that in 1998, we started another bank called EverBank. And that bank was one of the first of the internet-only banks in the United States.
Okay.
And it was a spectacular success.
Yes.
We grew from 0 to 28 billion in deposits in 14 years. We sold the bank to TIAA-CREF. Wonderful exit, wonderful job looking after our customers. TIAA, when they bought that bank, bought it to serve their 1.5 million existing members and beneficiaries.
Yeah.
Which means that the unique features that were exhibited by EverBank were no longer of use to EverBank. And the 275,000 customers that we developed over 14 years were left stranded. Being an entrepreneur, seeing a 275,000 person market that I helped assemble, I couldn't resist the temptation to come back and serve them. So our bank will be a branchless bank,
Okay.
an internet-only bank.
Right.
If you aren't technologically competent enough that this is our branch, you're not our customer.
Interesting.
Okay? We are a bank that won't profit from abusing our customers. We're not going to have 15 kinds of savings accounts, 5 of which pay you no interest. We're going to have one savings product that you could write checks against that will pay you interest.
Okay.
We will be in the top quartile in percentage paid in all of American banking. Our durable competitive advantage, very low customer acquisition cost.
Sure.
We have 275,000 customers who we think can come to us for existing relationships.
Sure.
We got those customers because they were subscribers to Agora. Agora now owns 30% of our bank.
Okay.
We have a waiting list to start this bank of almost 12,000 people who want to do business with us. When we started EverBank, our backlog was 0. Now it's 12,000. On the asset side of the balance sheet, amazingly, there's $33 billion, we believe, in gold and silver in the U.S. in segregated accounts, and there's no bank lender servicing that market. So providing what are in effect margin loans to holders of physical gold and silver means that we'll have a proprietary lending product too. And by the way, we know how to talk to the gold and silver community. It's what we've done for 50 years. So again, our customer acquisition cost relative to the customer acquisition cost, evidenced by, say, Royal Bank of Canada or Bank of America, will be much lower. There are a lot of people, and mercifully many of them known to me,
Right.
who own a lot of gold and silver.
Sure.
And they don't want to sell.
Sure.
But they have intermittent need for liquidity.
Right.
There might be the operation, there might be the opportunity to buy a rental property. They need the down payment.
Sure.
There might be a summer cottage for sale. They might want to buy more gold or silver.
Sure.
The fact is that there's no other financial institution that I know of in North America
Interesting.
which is offering revolving credit facilities secured by segregated accounts of gold and silver. The other thing that we will do, which we did at EverBank, which was stupidly successful, is introduce certificates of deposits in foreign currencies. We had a huge business at EverBank in first-generation immigrants to America. Families that had a business in Hong Kong and have a business in America. Families that had a business in Canada and they had a business in America. Families that had a business in Germany and had a business in America. They wanted federally insured deposits in their host currency, and they wanted to do currency transactions between their home currency and the U.S. currency at reasonable rates.
Right.
Royal Bank of Canada charges 2%. JP Morgan Chase charges 2.25%. For existing customers, we'll charge 50 basis points. We built an $8 billion business at EverBank in foreign currency CDs among first-generation immigrants to the United States. Real Americans, people who came here out of choice. We're going to do that again. It is alleged that copper has that.
Okay.
I get asked economic questions, and I answer them out of an eagerness to please. I am not an economist. I'm a credit analyst. It is alleged that Dr. Copper, as it's called, is a wonderful economic forecaster. In my career, I haven't seen a lot of evidence of that, but perhaps that's because I've misread Dr. Copper's missives. So I have to leave the answer there. The junior resource sector is really, truly hated. And I think it's hated because it's underperformed for so many years. Let's look at the gold mining business just for a second as a proxy.
Yeah.
In the period 2000 to 2010, the gold price went up 7-fold. Okay? Free cash flow per share among senior gold miners representing the Philadelphia Gold and Silver Stock Index fell. It takes real skill to generate lower free cash flow per share when the selling price of your commodity increases by that degree. My suspicion is at that period of time that they were given leave by the investors to grow. The investment attribute that they were asked to exhibit was leverage to the gold price.
Right.
Which is to say the investors asked them to be marginal.
Sure.
It's the lowest cost producer that has the most leverage. Well, if you ask somebody to be marginal, that's pretty easy to achieve. And the industry became so marginal that their cash flow per share fell. We've talked about the juniors, you and I, before.
Yes.
If you look at the length and breadth of the junior industry, there's probably 3,000 companies worldwide.
Yeah.
I would suggest to you that 10 or 15% are viable. 85 or 90% are non-viable. So if you look at the performance of the sector, the entire sector, it will always be substandard because 85% of the population is substandard. You have to, as an investor, look through to the 10% of the companies that are viable. Those companies in a good market generate so much performance that they add legitimacy and sometimes luster to the 85% or 90% of the market that are comprised of the lame, the halt, and the blind.
In conclusion, Rick Rule's insights into the retail banking sector shed light on significant concerns. He questions the adequacy of the commonly accepted 7% capitalization, expressing skepticism about the sector's well-capitalized status. Rule criticizes the sector's tendency to diversify too broadly, with many banks engaging in lending across an extensive 400 business sectors. This, according to Rule, raises doubts about the feasibility of maintaining underwriting capabilities across such a vast array of industries, even for major institutions like JP Chase. Furthermore, Rule scrutinizes the too-big-to-fail doctrine, particularly highlighting potential vulnerabilities in the financial health of banks like Bank of America. His remarks extend to the practice of carrying loans on books at face value, which he terms as perpetrating fraud. Overall, Rule advocates for a more prudent, focused approach to lending and a realistic assessment of risk for sustainable and responsible banking practices. Share your thoughts on these insights in the comments below, and if you found this discussion valuable, don't forget to subscribe, like, and share.